Welcome to the Deep Dive. We take your sources, articles, reports, earnings calls, and really dig into what matters. Today, we're looking at a real standout in retail, the TJX Companies. We're digging into their Q2 Fiscal 2026 earnings call from August 20th. And the big question driving our deep dive today is pretty simple. How does a giant like TJX keep winning, keep growing, even when retail gets tough?
Yeah, it's a great question because they really did put up some impressive numbers this quarter. The results definitely caught people's attention.
So what were those immediate standout figures? Let's just lay out the highlights first.
Okay, well, the headline grabber was probably the GAAP earnings per share, came in at $1.10. That easily beat the $1.01 analysts were expecting. And that's like 15% growth year over year. Really strong.
Okay, strong start on earnings. What about the top line, the revenue?
Same story there. Revenue hit $14.40 billion. The consensus was closer to $14.14 billion. So another solid beat. And that's a 7% increase compared to last year. Just good momentum.
Right, so beating on both top and bottom lines. But it wasn't just about the headline beats, was it? How did the underlying business look?
No, exactly. The consistency was key here. Consolidated comparable sales, that's sales in stores open at least a year, they grew a healthy 4% year over year, which really shows their model is working consistently.
Profitability. That's always crucial in retail.
Definitely. And they saw real strength there. The pre-tax profit margin expanded to 11.4%. That's up 50 basis points from last year. So half a percentage point gain, which is significant.
Okay, 50 basis points. Where did that come from?
Well, gross margin was up 30 basis points to 30.7%. They said that was mainly favorable hedges helping their buying. And here's a really interesting bit. Merchandise margin, the profit on the actual goods they sell, stayed flat. Flat despite higher tariff costs hitting retailers.
Flat despite tariffs. That suggests they're doing something right on managing costs or sourcing.
Absolutely. It points to, really effective strategies to handle those pressures. We should probably dig into that more. And one more thing on costs. SG&A, their operating expenses, as a percentage of sales actually decreased, down 30 basis points to 19.5%. So strong operational control, too.
Okay, good cost control. What about the balance sheet? Any surprises there?
Well, inventories were up 14% overall, about 10% if you look at it on a per-store basis. Now, that sounds like a lot, but it seems very deliberate, a strategic thing we need to unpack.
Yeah, a 14% jump in inventory definitely warrants a closer look. And shareholder returns.
Pretty significant. They returned $1 billion to shareholders. That's through buybacks and dividends combined.
Okay, so strong results, smart moves. How did the market take it?
Very positively, as you'd expect. The stock jumped pretty noticeably right after the announcement. Signals real investor confidence.
Right. So management must have been feeling pretty good on the call. What was the overall tone?
Oh, absolutely. CEO Ernie Herrmann said he was extremely pleased. He pointed to sales, profit margin, and EPS all coming in above plan. But it wasn't just looking back. He talked about a long runway ahead for growth, really confident about the second half, especially fall and the holidays, said they were seeing outstanding buying opportunities.
Outstanding buying opportunities and that inventory build seems connected. But let's talk profitability again. How did they beat even their own high-end plan on profit margin? You mentioned 90 basis points.
Yeah, that pre-tax profit margin beat was impressive, 90 basis points above their own best guess. It was a mix of things, really. Tariffs ended up costing less than they'd braced for. They got extra leverage from those better-than-expected sales, and some expenses shifted timing-wise, partially offset by higher incentive pay, but like you said, that's usually a sign things are going well.
And that flat merchandise margin, despite tariffs. You called it their secret sauce. Can you elaborate on how their buying operation makes that possible?
It really comes down to the agility and scale of their global buying team. You're talking over 1,300 buyers, sourcing from, I think the number was over 21,000 vendors across more than 100 countries. It's massive.
Wow.
And they don't work top down on price. They work backwards. They look at what competitors are charging and then figure out how to get the product to maintain their value gap.
Explain that value gap for us.
Sure. It's basically the core of their promise to the customer, offering branded stuff, quality goods at a price significantly lower than department stores or specialty retailers. They protect that gap relentlessly, deal by deal, item by item, SKU by SKU, as they say. And they're so flexible. If tariffs make a certain category too expensive to maintain that value, they can just pivot, de-emphasize it, and focus elsewhere.
Incredible flexibility.
Yeah.
And that value focus clearly worked across the boboard. Let's look at the divisions. Marmaxx, TJ Maxx, and Marshall. How did they do?
Marmaxx comps were up 3%. driven by people buying more per visit, higher basket size, and more people coming in higher transactions. And what really stood out, as you hinted earlier, was the strength across all income demographics.
That is significant, isn't it? It's not just one group driving growth.
Exactly. It shows their appeal is really broad. Everyone loves a deal, apparently. And it wasn't just Marmaxx. HomeGoods had a really strong quarter, comps up 5%. People are loving their home assortments.
HomeGoods continues to be a powerhouse for them. What about internationally?
Also very strong. TJX Canada had an outstanding 9% comp sales increase, 9%. And TJX International Europe and Australia mainly saw solid 5% growth. Really good performance overseas. And the common thread, the really key indicator, customer traffic, the number of transactions was up across every single division.
Traffic up everywhere. That's a powerful sign. Okay, let's circle back to that inventory increase. 14%. You called it a strategic defensive move. Unpack that. Why build inventory now?
Right. Management was quite clear on this. It wasn't just letting stock pile up. First, it lets them jump on those excellent buying opportunities they mentioned. When other retailers cancel orders or have overstock, TJX is ready to buy. Second, it ensures they have fresh, exciting stuff flowing into stores for the key fall and holiday shopping seasons, keeps that treasure hunt alive. And third, it's a hedge against potential future tariff impacts or supply chain issues. Buy it now when the opportunity is good.
So it fuels that treasure hunt experience. That's core to their brand, isn't it?
Absolutely core. The whole idea is you go in not knowing exactly what you'll find, but knowing there will be great brands at great prices, and it changes constantly. That constant flow of newness drives frequent visits, impulse buys. The higher inventory just feeds that discovery process.
And they're getting younger shoppers interested in this treasure hunt, too.
Yeah, that was another interesting point. Their new customer demographics are skewing younger than their current average customer and younger than the general population, which is, fantastic news for the long term. They're building the next generation of loyal shoppers.
Okay, another strategic shift that caught my eye. This push to be a year-round gifting destination. What's that about? It's not just Christmas anymore.
No, exactly. It's a really smart offensive play, I think. They see an opportunity because many traditional retailers focus heavily on Q4 for gifts and maybe pull back other times. TJX is saying, wait, people give gifts all year. Mother's Day, Father's Day, graduations, birthdays. So they're tasking their buyers and merchandisers to specifically target these occasions year-round.
So finding those unique gifts, maybe impulse buys at a good price whenever you need one.
Precisely. And it links back to their in-store execution, the storytelling and merchandising they talked about. Think about those really compelling back-to-college displays you might see at HomeGoods. It's not just stuff on a shelf. It's presented in a way that gives you ideas, makes you want it, that drives those impulse purchases and makes the shopping trip more engaging. It leverages their strength in offering unique items at great value.
Makes sense. Okay, looking ahead, they didn't just report a good quarter, they raised their outlook for the full year. Right.
They did. Shows real confidence. For Q3, they're guiding to comparable sales growth of 2% to 3%. And diluted EPS between $1.17 and $1.19.
And for the full fiscal year?
They bumped up the full year comp sales forecast to 3% growth and raised the diluted EPS guidance range to $4.52 to $4.57. That's about 6-7% growth year over year. And that's even with factoring in a slightly less negative impact from foreign exchange than before. They're assuming tariffs stay where they are now, but they seem very confident they can handle it with their buying model.
And they're still planning to open new stores, too.
Oh, yeah. Over 130 net new stores planned for this year, targeting about 3% net unit growth for the next couple of years, plus nearly 500 remodels. So investing in both expanding their footprint and keeping existing stores fresh, it's a clear commitment to physical retail growth.
So pulling this together for investors listening, the market reacted positively, you said. What was the broader sentiment?
Decidedly bullish, yeah. The stock climbed around 2.7% during the day after jumping maybe 4% pre-market. And analysts are generally very positive. Telsey, for instance, kept their Outperform rating, called TJX resilient and consistent, even with macro headwinds. The overall tip ranks consensus is a strong buy, and the average price target suggests analysts see more room for the stock to run.
In zooming out, how does TJX stack up against the competition and the broader market right now?
Well, they're clearly outperforming. Year-to-date returns were around 15.5% at the time of the call, beating broader market indices and direct peers like Ross and Burlington. It really highlights the strength of the off-price model in the current environment where consumers are very value-focused.
So what are those core competitive advantages driving this outperformance?
It boils down to a few things. One, That resilient demand for off-price. People want value. 2, their specific business model. Incredibly agile operations, that value-driven approach we talked about. 3, demonstrated execution. Maintaining margins despite tariffs, controlling expenses, that strategic inventory management, it's all working together. And 4, management sees huge potential still. They mention potential for over 1,800 more stores globally. Plus, they emphasize the experience and longevity of their leadership teams. That deep know-how is a real asset.
A long runway ahead, as the CEO put it.
Exactly. While some traditional retailers struggle, TJX seems well positioned to keep capturing market share.
All right, fascinating stuff. Now let's pivot to our This Is Not Financial Advice segment. Purely hypothetical, conceptual ideas here. Given everything we've discussed, the strong quarter, the inventory build, a holiday focus if you were pitching ideas in a hedge fund meeting, purely for discussion, what kind of conceptual trays might emerge around TJX?
Okay, purely hypothetical, right? These results, especially that big inventory bet for the holidays, do create potential for volatility. So, trade idea 1, maybe a long straddle for Q4 earnings. The thinking here is that 14% inventory increase is a bold move for the holidays. If spending stays strong and that treasure hunt clicks, huge upside potential, right? But if the consumer pulls back hard or they have to mark down all that inventory, significant downside risk too. The current raised guidance might not fully price in either of those extreme outcomes. So a straddle, buying both a call and a put option around the current price, expiring after Q4 earnings, is a conceptual way to bet on a big move, up or down, without picking a direction. You're betting on high volatility.
Interesting. Betting on a big swing either way because of that inventory gamble. What else?
Trade idea 2. Playing the pure divergence, maybe via a long strangle, TJX made a point of highlighting how they're outperforming peers like Ross, Burlington. If off-price stays strong, TJX's agility might let them widen that lead. But even they could get hit in a really bad retail slowdown, though maybe less than others. So this is a more nuanced bet. It's betting that TJX, because of its superior execution, will have more volatile moves, bigger swings up or down relative to its less agile competitors. Conceptually, you might look at buying out-of-the-money calls and puts on TJX, that's the strangle part, slightly different from a straddle, again, betting on a large move. And maybe, just maybe, contrast it by looking at shorting some near-term out-of-the-money calls on a competitor or buying their puts. Betting TJX's moves will be relatively larger in magnitude. It's complex betting on relative volatility.
Okay, 2 interesting conceptual plays focused on volatility and relative performance. Thanks for that. And that really wraps up our deep dive on the TJX Companies Q2 Fiscal 2026 earnings call. So, to quickly recap, an exceptional quarter all around. Strong beats, they raised guidance confidently, made a big strategic bet on inventory, they navigated tariff pressures incredibly well, and their core value proposition is clearly hitting the mark with shoppers.
Yeah, the management confidence was clear, backed by solid execution. They seem genuinely convinced they can keep grabbing market share globally with their flexible model.
Which leaves us with a key question to ponder, doesn't it? In this constantly shifting retail world, can TJX keep evolving that treasure hunt? Can they adapt not just to the economy, but also to how people want to shop now, looking for gifts year-round, wanting those curated experiences?
It seems like they've definitely laid the groundwork to try. It will be fascinating to watch.
Absolutely. Now, just a reminder for everyone listening, our discussion today is for informational purposes only. It is definitely not financial advice. Please be sure to consult with a qualified financial advisor before making any investment decisions. Thanks for joining us through the deep dive. We'd love to hear your thoughts on TJX's results too.